Thank you. So I am a happy customer of ownership coins. I think they are extremely underrated and undervalued in the market today, and that will change quickly, and I want to tell you why. So the two main points of my presentation are, one, kind of a central metaphor that capital markets are like evolutionary environments, and the companies that develop around them and the founders that develop within them really reflect the properties of the capital market. We'll get into that. Clay did a good job getting into that earlier today. And the second is just the basic claim that ownership coins have created superior tokens. We've solved the token problem that has plagued the industry with ownership coins, and they are, in my view, very, very valuable assets. So on to the first metaphor. Companies evolve to fit their funding markets. Show me the cap table, and I'll show you the outcome. This is obvious when we think about something like venture capital. Venture capital is 5 to 10-year funds investing in companies with a very high failure rate, where you need, by the math of venture, to have a huge 100x outcome to return the fund, have a great fund, and then raise more capital. And what you get from that incentive structure is people pursuing network effects, building social media companies, people investing in winner-take-all markets, ride-sharing markets, and amazing ideas like frontier AI models. Very grateful to venture capital for everything it does for us in the economy, but it does have its limits. You can't really invest in a 10 to 20x upside company if you're a venture investor. It doesn't make sense for your model. We have public markets and private equity that want predictable, recurring cash flow. In the case of public markets, because it trades well. In the case of private equity, because you want to add leverage. And that's why Netflix charges you every month, raises price every year, and why in New York City you have veterinary clinics with monthly subscriptions. And each of these capital markets creates a different founder type. Venture capital has the aggressive founder banging on tables, talking about the big TAM, and looking a little unbalanced as a person, trying to show that they can go after a huge market well after their monetary needs have been met. In public markets, you have the faceless CEO who will talk about synergies when he's talking about closing down 10 or 20 factories like it's no problem. That is the archetype that develops from the evolutionary system of these capital markets. So my core claim is that we in this room are developing a new capital market environment with MetaDAO together. And that will create a new type of asset, a new type of company, and a new type of founder. What have we done with that privilege, and what have we done with our expanded design space on MetaDAO so far? I think the first thing we've done is to create ownership coins, and ownership coins are superior tokens. Why do I say that? Traditional token launches, and we all know the story, had a big incentive problem. If you were launching a traditional token, you would give yourself 20% of the token supply as a team. You'd make it all time-based vesting, so you'd be fully vested after 3 years, maybe 2 years, and you'd go through the low float, high FDV pipeline. That means working with the right Asian exchanges. That means working with the right podcasts to build narrative before launching, working with your VCs to publish big price DCFs that don't really make sense, and keeping that token chart afloat as long as possible while you vest, exit, and abandon the business. My claim is that the last 5 years have seen very little by way of company creation in crypto, not because there's a technology problem and not because it's a market problem, but because there is a capital markets evolutionary system problem. We have rewarded narrative and founders exiting businesses instead of rewarding business building and long-term alignment. And that's why we have had the stories the last 5 years, basically. MetaDAO solves this at every step. Where the incentive with tokens, if you're fundraising on the internet with tokens, the incentive is to take the money and essentially run, move to Thailand, move to a beach town and stop working. The incentive with MetaDAO is that all the money goes into a treasury and you'll get liquidated if you do that. Where the incentive with tokens is to build a big narrative before your public launch on an Asian exchange and do a low float, high FDV launch. The incentive with MetaDAO is that you actually launch your business at cash value. and we'll get into that a little bit, but you launch your business at 0 enterprise value. And your incentive is to build enterprise value because you keep a large percentage of that enterprise value. Where the incentive with tokens, in the case of an acquisition, is to sell the business to Coinbase, get paid out yourself, get a high salary and a big position at Coinbase or Kraken, and rug the token holders. You legally can't do that in MetaDAO, and you physically can't do it either. So your incentive is to actually do an acquisition that is valuable for the token holders so that they approve it through the decision markets. Every incentive, one by one, has been changed by ownership coins. This is not an accident, of course. It's what the team's been working on this whole time, and it has created a superior token. One quick point here, what I said about cash, I think it matters. People are very confused about what market cap is for ownership coins when they launch. Circulating market cap for an ownership coin is the cash raised. You launch at 0 enterprise value. The difficulty of our is move on. That will prove to be valuable over the long run. And I'll say one more thing about that. We've seen from my anecdotal experience, ownership founders working twice as hard as other ownership founders in the last 10 months. And I believe the reason why is because they are seeing market feedback every day on performance, and they have that fire of real-time insight that informs the decision. Time will tell, and that's what we're seeing. I believe that's across the board, or should be across all the. Two, continuous underwriting. In venture, you have to underwrite a project before, with the research in the market, you're not going to found a new person, and then you make it through the community. In reality, all investors know that most information comes after the initial investment. So you see how time responds adversity, you see how market conditions change, an opportunity comes from on temper, like flight dives. And not so great information evolves. Every year we got 8 hours in here, so these are good. One point allow me to right now. And Congress can respond by activity, get information, or you can learn that some found. You get half the money back from the failures. Again, that is lower than what we've seen in MetaDAO. People got 1x money back on the 2 failures. And you're able to recycle capital. You put it back into the pot. You try to make it a good investment. The MOIC return required for a VC to get a 3x fund on these assumptions is 60x. And that's what you see in venture capital. People are going for huge outcomes constantly. But if you look at an ownership coin fund that can recycle and gets half their money back, you only get 19x return to get your 3x fund on the same underlying company base. It's a huge difference in the return profile required. And I believe that's why you're seeing people fund ideas that are extremely attractive, but not traditional large TAM venture ideas on MetaDAO already. The next 2 graphs kind of make the same point. Fund MOIC is higher for ownership coin funds because of liquidity, continuous underwriting, and recycling, and the probability of a 3x fund is significantly higher. This is the same point I made before. I'll breeze through it. Basically, venture has to fund 100x ideas, or 60x ideas, like we saw on the last page on those assumptions. With ownership coins, you can have a mixed portfolio. You can fund venture ideas, but you can also fund ideas that have a 10% chance of getting a 10 to 20x return. And that actually is extremely accretive to your portfolio if you fund those ideas. And again, you can only do that because of the intrinsic properties of ownership coins that are not available in venture. So that's what I think that kind of rounds out what I think ownership coins can do to expand the traditional venture investment base. These things are really important. Most businesses in the world are not in the Fortune 100 companies that kind of hyperscale their way into world domination. Most companies are $20 to $100 million EBITDA companies. That's what employs most people in the world. It's what most people make money in the real economy. MetaDAO can actually fund those businesses on the internet and in the real world. That's only scratching the surface. I think we're in the beginning of a very long period. Prophet talked about, these are some ideas of what we can do after that I'm excited about. Prophet talked about micro fundraising. Venture typically means going through a 2-month process to raise $2 million. There are people like Coliseum that make that faster, which is very valuable, but what most of venture is that long, distracting, drawn out process to raise a large amount of capital, raising 200K in a weekend. What Vukan did with Jurassify, that's a whole new market that MetaDAO is opening up with micro fundraises. On-chain investment funds, I think that the Mountain Capital was actually an idea in the right direction. I think the mistake there, well, there was a mistake with the kind of the initial parameters of the launch, but I could see a world where there's a separation of GP and LP, so you have a fund and a manager, and those are separate entities, and the decision markets are about the manager. So Mountain Capital didn't have to liquidate. They could have just fired the initial team, and another fund, like us or somebody else, could have apply to become the manager of that fund. It's a very interesting structure. A lot of venture capital funds in the world are burning capital, and every LP knows it, and they can't fire their managers. But with MetaDAO, you can, and you can make that a liquid market where managers are judged and fired every year, just like most people in the real world. There's no guarantee for 10-year employment. And then I think the holy grail is entrepreneurship in medium and low rule of law countries. The whole world is littered with 20+% IRR opportunities that are obvious to anybody who builds a spreadsheet, but you can't access them because you don't have, the legal system does not allow that project to work, does not allow capital to flow to that project in good faith. I think if MetaDAO is able to solve fundraising on the internet, where 90% of people are scammers, then it will be able to solve entrepreneurship in low and medium rule of law countries. There's a lot of work being done on that. That is the truly world-changing idea that MetaDAO is working on. Those are a bunch of words. I'm usually a little bit skeptical when people say a lot of words. Words tend to morph to the incentive structure of the speaker. So what is the objective real test that we need to meet at MetaDAO? I think there are two tests. One is circulating market cap to USD invested of MetaDAO companies. That answers the question, is MetaDAO creating companies that are valuable for investors? Are you getting more than $1 market cap out for every dollar that you put in? And test two is value creation for customers, revenue to USD invested. Is MetaDAO creating companies that are valuable for customers, valuable enough for them to pay revenue? You could do net income too to consider costs, but this is simpler. I think that MetaDAO needs to beat traditional crypto venture on these two metrics to prove that its model works. And as long as it's not winning on these two metrics, it is not living up to its promise. How are we doing today? It's early. If we include MetaDAO itself, which is an ownership coin, of course, liquid DPI for the MetaDAO ecosystem is about 2.5 times. That's pretty good, actually, given the time period. Better than the market now. Expect it's winning out against crypto venture. If you exclude MetaDAO and only use the recent cohort, MetaDAO is at about 1.2 times liquid DPI. Again, it's pretty good relative to the market, but it's nowhere near the cost of capital. So there's a lot riding on this first crop of MetaDAO founders that we've been speaking to today to prove the model, and I believe they will. So I guess I'll say one last thing before wrapping up. Ownership coins make my job as an investor really fun. Make it sometimes a lot easier too, because these are intrinsically very good investments. I think there will come a time when ownership coins trade at much higher multiples than tokens and even equities because of their appealing characteristics. But we're in this kind of market moment where people don't recognize that. So you get to make a lot of easy decisions. About a year ago, there were 2 funds buying ownership coins. Now I'd say there's about 2 handful of funds buying ownership coins. And I think in 3 or 4 years, there'll be hundreds. So enjoy this market moment while it's around. Markets don't stay uncompetitive forever. Really nice things don't stay cheap forever. Eventually, things will re-rate and it'll get a lot harder.
What do you think the cost of capital is for a crypto liquid fund?
Today, I would say above 30% easily, because, and probably above 40%, but let's say 30, because crypto liquid funds have eviscerated capital over the past 6 years. And LPs and fund of funds, what they do is they compare you to the asset class and say, this asset class is risky. This person might seem serious, but I don't know what will happen in the next few years. I need to do better than equities to invest in this asset class.
What has been the average returns, do you know?
It really changes. So I can actually just send the data source. But there are years where it's 100, and there are years where it's minus 75%. But most people who have invested in liquid funds over the past 5 years are unhappy with their returns.
Any other questions? Over there, Adam.
Do you explain that there's a gap in capital allocators that we need for ownership coins?
Yes, I think we are in that gap, and I would love to see dozens more funds come into that gap.
Do these funds need structures, or can they
No, I think it works. It works fine with a liquid fund structure with patient capital. You can always do better by, there are liquid funds with 3-year lockups or, more stringent redemptions would probably be better on the margin. But if you have a stable LP base, then it works fine. Same thing with public companies. A lot of funds take 5-year views on public companies and have quarterly redemptions or annual redemptions, and it works fine. You just have to manage your LP base.
You guys have to become an activist fund. What do you think to get you in that phase?
I think that anybody who's investing in ownership coins should seek to be an activist fund. One, because the returns to activism are so much higher. You can actually implement decisions. You don't have to, if you're an activist fund in tokens, you have to beg the ant team to look at the treasury for a year and they don't do it, right? If you're an activist fund in MetaDAO, you can, in 20 days now with the new rules, liquidate the treasury if they don't deserve the capital, or replace the CEO or effect an acquisition. So you would be losing a lot of alpha if you did not play as an activist fund within decision markets.
If he adopted his proposal to have the board approve decisions, would that make it easier or harder for you to do that?
Easier, much easier for us because we tend to be friendly activists, not vulture activists, which also participate in the ecosystem. Given you asked about profit, given my guess on how that board will look, it'll be fairly permissive with things that are value creative, and it'll be restricted with things that are kind of vulture tactics, and we don't do those anyway, so it'd be fine for us. But it will eliminate a part of the capital market right now that I see as destructive to the ecosystem, not additive.
Awesome. Thank you, Felipe.
Thank you.
Oh, one more.
So like right now, the funds that fill that gap is probably what, like you guys, DBA, Anagram, there's like a handful of funds.
Yeah, Coliseum, Trident, new player, in the back.
How do we get that to like 20 months?
I think you're doing that already. I think just more time doing what you're doing. Connor's doing an amazing job bringing in new funds. I think the funds that are already doing it see that we would all benefit from more competition because it would lead to more companies launching. So right now it's a point where bringing in new funds is still positive EV. So still talk to new, every fund doing this should talk to their friends and kind of pitch how good this is. What you're doing with ownership capital, which I think you'll go over in a bit, is really additive, just like bringing new funds to the space. But it's more of the same. I think that trajectory is clearly going in the right direction already.
Better returns with best marketing.
Correct. Yeah. Capital comes really fast when returns are good.
Thanks, Felipe.
All right. Thank you.
Next up, we've got Noah from Theia Research, who's going to talk